This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jonathan Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts. And always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app.
This is the interview of the day on rates. Ian Lyngen is watched across all of global Wall Street. At BMO Capital Markets, he writes incredibly terse, dense notes on the dynamics of fixed income. He joins us this morning. I got 8 ways to go here. One single sentence. Friday, you call most influential jobs report of 2023. Why?
I think that the relevance of non-farm payrolls on Friday simply can't be overstated. The Fed has achieved what they wanted to, at least thus far, in terms of moderating CPI. Now, the question is, have they overshot on the jobs front? We know that jobs are cooling. We are expecting a relatively benign, the consensus I think is 170 for headline non-farm payrolls, but we do have that JOLTS print, and the quits rate within that is very troubling. It's now down to 2.3%, which was the average between 2018 and 2019. So we're back to kind of the pre-pandemic norms. So what happens for the macro outlook if we get a disappointing jobs print?
What concerns you most, the number or the speed, the rate of change?
I think that if I were given the choice between the outright level and the rate of change, I would say we're at the right pace. We're just getting to levels that are far more concerning. So I would go with not the rate of change yet, but the outright levels.
Okay, and if the levels and the rate of change suggest that the Fed's work is getting closer to being more fully accomplished, obviously there's still a long way to go. The move in the 2-year yesterday would suggest that has run perhaps too far. Did we see the peak already? We hit that north of 5%, stayed there for a little bit, and now we're done?
So a lot of that comes down to whether or not the Fed is able to avoid cutting rates throughout the first half of 2024, even potentially avoid cutting rates until the beginning of 2025. Now, I don't expect that will happen, but there's a contingent in the market that thinks that higher policy rates are going to be in place for the foreseeable future. And if that's the case, we're going to see 2-year yields back up above 5% again, which we continue to view as a pretty attractive buying opportunity.
But when we're thinking about how the Fed is going to be thinking about deciding whether or not to cut rates next year, is the bar for that even higher than the bar for them to hike again, given how this Fed has been conditioned by the mistakes it made earlier on?
Mm-hmm. That's actually a great observation. What I would say is the Fed has already signaled that they plan to cut rates by 100 basis points next year, but they're going to allow the QT to run off in the background or to continue shrinking the balance sheet. And so what they're doing is they're reframing the conversation around rate cuts being a response to a slowdown and rate cuts being a recalibration closer to normal policy rates. So I think that they've given themselves a fair amount of flexibility for the year ahead.
Ian, all anybody wants to know is for you to frame the real rate. The 10-year real rate, we got up to 2.0. I've got some numbers above that which show the real stresses. Bracket the real rate right now where it could come back down to that level. We're now at a 1.8384, whatever, and then bracket up. Frame that for us.
If I were to put a range on 10-year real yields, I would put it at 165 to 215. And that's well within what the Fed wants to see.
Okay, but if at 215, I don't mean to interrupt, but this is so important. If we pop to a 215, what does that do to the greater American financial system?
I think that's when we start to see strains in equities, in risk assets, and it becomes a much bigger burden for the overall business community.
Let's put it all together. There's clearly a dividing line between the kind of data this Fed appreciates, wants to see, it's objective, and what you think is undesirable. Mm-hmm. And what I sense from you is that we're creeping towards the latter and moving away from the former. And if that's the case, isn't the 10-year Treasury in your mind a screaming buy right now?
The 10-year Treasury in my mind is a screaming buy. I think that from here, the path forward for nominal 10-year yields is going to be lower for two reasons.
Oh, slow down. I got to take notes here. Just read me by.
for two reasons. One, the Fed's credibility is being reestablished as an inflation fighter, and that will put downward pressure on break-evens. And one of the reasons that real yields are where they are is because break-evens haven't repriced higher. Think about Jackson Hole. They're holding the 2% inflation target. They're doing everything that they can to convince the market that they're here for the long haul in the battle with inflation. So if we believe, which we do, that there is still a 6 to 9 month lag of monetary policy actions hitting the real economy, the second half of this year is going to be pivotal for the effectiveness of what Powell has been attempting to do.
So is he saying load the boat on the 97-year Austrian?
Not
is that
quite.
What I heard?
Not quite. Not quite.
Is that how I translate that?
10-year treasury
I got to make some money here.
Ian, I think we've got to put some numbers on it. Difficult to do, I know, but I just want a better understanding of the direction here and what you're looking for. Right now, north of 4%. We got through 4.30 in the last week or so. What are you thinking about? 3? Could I go to a 2 handle? What kind of numbers are you thinking about?
I think that we do get 10-year yields back to 3%. I don't think it happens this year. I think that that will be a first half of 2024 event, but we can easily close in a range of 350 to 375 by the end of this year.
And that's not just monetary policy dependent either. It's fiscal as well. Treasury's still issuing a ton of debt. We have a deficit spending that we need to fund. How does that factor into this equation?
I think that what primarily sets the outright level of Treasury yields are the global macros of inflation and growth. The incremental supply considerations will lead to concessions in and around the events themselves. And frankly, the market knows that there's a bunch of Treasury issuance coming. We have that largely priced in. The Treasury Department has been very clear in their signaling. And still, we have 10-year yields at 4.15, not 5.15.
I look at this, and I just look at what will break. Torsten Slok is out this morning with a spectacular look at Ian Lingen's market has changed, and there's the debt servicing costs up, but we're also making more on our coupon, up. Mr. Slok takes it back to 1959 that this market is out of whack. Do you sense that as well, that your world's that out of whack?
I do think that there is a significant mismatch between the primary buyers of treasuries and the incremental players. The people who are fundamentally adding treasuries, whether it's a major central bank or an institutional investor, they're really generally starting to look at these levels as attractive buying opportunities, especially once we have some degree of clarity from the monetary policy side. The incremental investor, people playing for a quick 2 or 3 week trade, I think, are a lot more aggressive on the bearish side. So there does seem to be a fair amount of mismatch.
Ian, it's good to see you. And I apologise, we'll run with that headline all day because I put words in your mouth, but there we go. It's financial media for you. Ian Lyngen there of BMO Capital Markets.
He wasn't at Jackson Hole. He should have been. He would have done the 31-mile paintbrush divide hike. It goes way up in the tundra there at 12,000 feet. Dr. Carpenter darkens the door. With many years of experience at the Federal Reserve System, Seth Carpenter is with Morgan Stanley. You have to corral Zentner when she's not in some trout stream trying to catch trout. What is the Zentner mood now, the Morgan Stanley recession meter? Have we just discarded recession?
So I wouldn't say that we've discarded it wholesale. There's always a risk. As I like to say, bad things happen to good economies all the time, Tom. But, since the beginning of this hiking cycle, we've tried to say a soft landing is the most likely outcome. The economy is not going to go into recession as a base case forecast. And so far, that view has come true. I mean, it was not, I have to say, the most popular view with our clients 3 months ago, 6 months ago, 9 months ago. Mm-hmm. On the other hand, things haven't slowed down quite as much as we thought it would either. Mike was talking about the GDP data. The downward revision sort of pulls things sort of along the slowing line, but it's still a pretty punchy number. 2.1% is above, I think, most people's estimate of potential growth. So we still have a ways to go. We still think there's more drag from monetary policy in the pipeline. But inflation's coming down. Job growth is slowing. We'll get another print on Friday. Our number is, I think, around 155 for private payrolls. So that'll be another tick lower in terms of job demand. We saw the JOLTS data that had a market reaction as well. So things are cooling off a bit, but they're not cold.
The hallmark of Morgan Stanley economics is invented by Stephen Roach and Richard Berners. Everybody fights like cats and dogs. What is the point of conversation around the desk at Morgan Stanley? What's the thing everybody's arguing about?
Right now, I have to say every corner of the world has its own quirky story. I mean, I think for us in the U.S., there's definitely the slowdown, the soft landing, but boy, the data are surprising to the upside. In very stark contrast, on the other side of the world, I'm always in conversation with my team in Asia. China, we had come into this year pretty bullish on China. The first quarter was super strong, and now things have slowed down a great deal. And so the question is, when do we get enough of a policy response from Beijing to pull things back in? So that's where those are two of the main topics where we're really debating.
Yeah, and we've talked about China a lot in recent weeks because it just seems like piecemeal, one thing after another, they're doing things to try to stimulate that economy. Just to return to your soft landing thesis and the avoidance of a recession, are we really talking about a recession entirely avoided, or one that potentially is just pushed off, just delayed further out into the future as we think about these lagged effects kicking in a way they have not yet fully?
I mean, I think that still remains a key question for us. We still think it is a recession avoided. That's been our view for a long time. The trough, though, in terms of economic growth does seem like it's got pushed off a little bit. We think things will come down further from here. And there are things besides monetary policy that are a downside risk for the rest of this year. I mean, student loan moratorium, that has gone away. If you look at the Treasury's daily Treasury statement, you can start to see some of those inflows going. So that could weigh things down. On Ellen's team, Sarah Wolf is our consumer specialist, and she's been all over student loan debt repayments as a really key downside risk for the fourth quarter. So are there still risks of a recession? Absolutely. There always are. But we don't think that's the main story, that the labor market slowing but still resilient.
Yeah, in October, that's definitely going to be something of concern. 2 weeks before that, though, actually just 2 weeks from tomorrow is when we're on watch for a United Auto Workers strike. How are you thinking about the labor movement in particular, the power of these unions to ask for things as audacious, to use their own words, as a 46% pay hike? What does that signal to you about still the supply issue and the ability of workers to demand more?
So I think it's definitely something that's going to matter a lot. We already have one strike in the books, right? The Screen Actors Guild and all of that. And that's going to have an influence on Friday's jobs report. And so we're going to have to try to read what the underlying trend is in data. So I think the first part of it is going to be not to be, hopefully avoid being confused by swings in the data because of if there is a strike with the United Auto Workers, what that means for the numbers. But yeah, I mean, you've got a question of how long are they on strike? How much does that disrupt production if they are? We know that the auto industry was one of the last ones to be able to catch up to supply chain disruptions. Now we're starting to see auto prices fall. So it's a real mixed bag. I think we're going to be trying to watch very, very closely. We're going to pull in our equities analysts who cover the auto industry to see sort of where production is going. But for now, I don't think it's easy for us to forecast whether or not the strike will happen.
At your Princeton, a guy named Bernanke wrote a really important paper, Bernanke Del Negro, on R-Star. We missed you at Jackson Hole. Give us the Carpenter R-Star debate. Should our audience pay attention to it, or is it economic babble distraction?
It's a little bit of both. I mean, it's hard to avoid the relevance of the concept of R-Star. So how high is the level of interest rates that's neither stimulating the economy nor putting a drag on it? That's got to be fundamental to everything about the economy. But in real time, at any specific point in time, knowing where that is with any precision is borderline impossible. The statistical models that lots of my academic-minded colleagues use are really, really, really sophisticated ways of showing off how much math you know. But at the end of the day, all they can do is say, we know where the current level of interest rates is. Let's just look. Is the economy accelerating or decelerating? And then we make an inference about whether we're above or below R-Star. So I don't think there's a whole lot there that you can judge for sure right now. Over time, if the Fed keeps the policy rate where it is now and the economy not only doesn't slow but starts to accelerate, a quarter from now, 2 quarters from now, you gotta have a view. But the same thing could be said. There could be extra residual push coming on from fiscal policy. That doesn't tell you anything about the permanent level of R-star. That just says right now there's more demand.
Dr. Carpenter. Thank you to Peter Tchir for attendance right now, head of macro strategy, Academy Securities. Peter, did your journey in the markets, did it change yesterday with the JOLTS report?
Not really. It was more or less in line with what we're looking for. Is basically the Fed is looking for an excuse not to hike. So they're going to be looking across a broad spectrum of data. And I think the one area that's going to disappoint is jobs. I think there are going to be downward revisions. You mentioned a bunch of other parts of the JOLT report yesterday. The hires rate continues to drop down. There's been this dichotomy that the hires rate has been off very strangely low relative to job openings. I think that's going to catch up. So as jobs slow down, I think the Fed's going to have the excuse to do nothing. And then it's going to become a question of, were all the economists, including myself, who are looking for a recession this year, going to turn out to be right or not?
Okay, well, as we talk about whether or not you turn out to be right, if the job market is slowing down, if we're starting to see the growth deterioration happen, but inflation is still too far above where the Fed would like to be, which they say still is 2%, what do they do then?
I think the key word is they say is still 3%. I'm not sure it's really 3%. I think they're going to be looking for excuses to delay. So I think we get 10-year yields back to 4%, and then we're going to need significant either jobs data, consumer sales data, real, inflation data again, because they're already trying to downplay some of that, saying they're seeing it finally trickle into the housing market. So I don't think they do anything if they can avoid it at all.
Pete, we talked about the housing market the last couple of days. Home prices in America totally distorted by the rates of the last 2 years at record lows and the rates more recently at 2-decade highs. Pete, is that something they can ignore? Can they ignore the distortions of house prices, given their contribution to shelter and what might be elevated inflation for maybe the next year or so?
I think sadly they're going to have to. Partly this is very location based. So when you look at what the home builders are doing, and they've been very successful, they're building homes in areas that people are moving to, right? As people continue to leave California, maybe Illinois move to other states, that's where they've been able to take advantage. So I think we're seeing a very regional economy, particularly on housing. I think the Fed's just going to have to give this time for people to either get forced to move, choose to move, figure out what they're going to do with their mortgage rate. So it's problematic. Again, I think this all goes back, and we're not, going to hammer home on this. They were so slow to react. They allowed this bubble to create itself. They should have reacted much sooner, much earlier, done much more. Unfortunately, we're here. So I think this is just going to take time to play out, unfortunately.
Your view sounds like high for longer. Ian Lyngen of BMO came on this program moments ago, Pete, and he said 10-year Treasury yield, 10-year Treasury, screaming buy. He thinks yield goes down to 3%. He indicated that, and these are my words, I'm paraphrasing here, but ultimately, Pete, his characterization of the data was this isn't desirable, some of this is undesirable. Maybe things have gone too far. Pete, what's the counterpoint to that?
One, I'm definitely worried that he could be right. So I think we get to this 4% on the 10-year. I think that's good for stocks. Then I think we actually get to 3.8%. As we start moving lower, it becomes negative for stock because people have to start repricing in, is there a potential recession risk? My outlier on the inflation story is really India. I'm watching India to see if they can generate some growth, what happens with China. So if we get inflation, I'm not really worried about domestic inflation. I think we're seeing enough slowing down, both in the goods and the services market. Inflation is not going to be domestically generated. It's going to be something happens with India or China. That could set us off that way. So I'm kind of into an inflection point. Right now, I'm very comfortable. Yields lower, down below 4%, good for stocks. As they go much lower, weak for stocks. Then we'll see how the data plays out.
Peter, overlay on this the geopolitical matrix. Academy is acclaimed for putting a geopolitical tinge on my investment. Is it steady as she goes, or do I need to worry about geopolitics into next year?
I think we need to worry about geopolitics. Certainly what's going on with Russia, right? Putin clearly showed his hand when he was willing to kill the person who went against him. So don't forget what's going on between Russia and Ukraine. But for us, the real story is still China. And I think people are underestimating China's desire to start selling their own goods, their own brands, and possibly denominated in yuan, mostly to emerging markets countries. And when we sit here and examine China today, they are clearly experiencing trouble.
Yeah.
They're going to do some things to fix that. But I think it's going to have to be pushing their brands globally.
Well, Peter, to your point on China, I was really struck by the research that came out in the last 24 hours by our own team here at Bloomberg Economics, talking about China's property sector as being both too big to fail and too big to save. They say the government step in and rescue the sector? When looking at the options, it suggests the load would be too heavy to bear. Is China in a position right now to flex on anything?
That's a great question. So how we're looking at China is I think they are going to cram down on the rich. So I think as this property sector resolves itself, they're going to try and protect what's left of the middle class, and it's going to hurt the rich. But I think those are all relatively weirdly short-term problems. The real problem that they face right now is, one, no one really wants to produce in China, right? People are moving their production out of China. That is not going back. It's political. It's too long term. So they're not going to be this factory of the world any longer. And it's clear that, one, Chinese customers don't consume the way American customers consume. So their ability to develop a real domestic economy is weak. They're going to have to support that with the housing market or the real estate market there so people can spend. But they are going to have to look to selling their brands offshore. That's the only way they're going to be able to produce enough goods to keep people employed. And I also worry, and I think our geopolitical team always cautions us, right? When things are good in China, they are less likely to flex their political or military muscle. As their economy weakens, they do something like that, just like we saw Putin do.
Well, Pete, bad folks do bad things. What kind of bad things are you thinking about?
You know, I think Taiwan's off the table. It's not going to be that, but look for them maybe to flex their muscle in some other regions of the world where people care less. Look for them to continue to expand through their Belt and Road Initiative, more access to ports, more access to these countries who are failing to pay on that. And I think you're going to start hearing more and more trade occurring in yuan. And that's something people kind of, I feel, in our denial, because we're getting a lot of anecdotal evidence when we talk to companies. They're being pressured to do some contracts in yuan. It's very small, mostly isolated in emerging markets, but this was not something anyone was talking about 2 years ago. So I think this trend is there. And I think U.S. companies are going to have to take a real stock of, hey, do we have exposure to selling our products in emerging markets? Because China might become a real competitor. How do we deal with that?
Well, Pete, I want to talk about that just one step further. Domestically in China, how are US brands going to compete on the mainland, in the domestic market, given the kind of things that we're discussing right now?
I think it's very difficult. I think everyone still has this, it's impossible not to look at 1 billion customers and say, wow, if I could just reach a fraction of this, I'll do well. I think the regulatory hurdles are going to remain extremely high. I think China's not really going to be friendly. So you can go there, but I think you want to put in limited intellectual property, limited resources, because that's not the wave of the future. If anything, I think you're supposed to be figuring out, what do we do with India? India is a much more compelling case to me right now than trying to figure out how to sell into China. But clearly this friction's ongoing, and the reluctance for them to do business with us is increasing.
So, Pete, I've got to raise this question, and forgive me for bringing single names into it. You can answer it directly if you want. You can dance around it, but it's got to be said. Where does it leave Apple? Where does it leave Tesla?
You know, I think we're already seeing some of those companies move their supply chains, develop around this, right? So they're looking at that. And I think that's been stage one of this. I think stage two is going to be, how do we protect our brands in some other countries? So I think companies are now maybe a little bit behind as a whole, but dealing with the China issue. And I think what they've got to get ahead of is, what are we going to do with the rest of emerging markets as China becomes potentially a competitor of low cost? You know, they're going to flood the market with their low cost, maybe lower quality goods. And that's, I think, what we have to be thinking about. So I think companies have done a decent job adjusting to China. I think they were slow as a whole, but that's going to be really the next phase, is adjusting to Chinese competition.
Pete, before we get ahead of that, let's get ahead of this. ADP, the number just around the corner. I've got to go to Mike McKee in a moment. Pete, what are you and the team looking for from ADP today? Claims tomorrow, payrolls Friday.
I'm looking for weak numbers, and whether it's in the headline numbers or, more importantly, even the revisions, because we've seen pretty significant revisions lately that people have somewhat ignored. I think it's just going to kind of really, solidify this view that we are the best for employment's behind us.
Peter, thank you, sir. Peter Tchir of Academy Securities. Joining us now is Margie Patel, Senior Portfolio Manager at Allspring Global Investments. Margie, big day of gains yesterday. Are you still constructive on this equity market in America?
Yes, I think we'll have a strong finish to the year, maybe more moderate returns than we've had year to date, but still a positive return because the economy is still pretty strong.
Margie, I look at where we are on free cash flow. In the heart of the matter is, there's a generation of people that don't know the rate structure we're in right now. You and I have lived it. Can corporations generate free cash flow? and dividend growth from it in this interest rate environment?
Oh, yes, because I think interest rates is just a small part of their costs. If you look at companies since the financial crisis, they have restructured their balance sheet, locked up fixed rate, low rate money. And so I think they're really rather impervious to these increases in rates. I think that's one of the things that's fuzzled the Fed. But I expect they'll continue to maintain profit margins.
I like the idea of impervious as well. If I'm a CFO, how do I change my issuance given this high environment? Do I extend out duration? Do I stay short? What do CFOs actually do in a real rate environment?
Well, I think most of them have already done that. For the last 5 years, particularly in the high yield market, we've seen more than half of all the issuance being to extend maturities, pay off bank debt, refund or pre-refund issues coming due in the next couple of years, a so-called maturity wall. So I think most companies really don't have the need to borrow new money. They have enough liquidity on their books to handle their own needs.
Well, when we talk about the companies and their borrowing needs and just their financial position, Margie, what is the default cycle actually going to look like when they, to this point, have remained incredibly low? There is growing calls for a soft landing. You seem to think that everything is still looking relatively strong here. Does that mean that there's not that much risk in riskier debt?
I think particularly in the public high yield market in the U.S., that market is going to continue to have very, very low default rates. Right now, the default rate in the U.S. is a little over 3%. In the loan market, it's higher. It's over 3.5% because a lot of the poorer quality issues finance there rather than the high yield market. But as I said, most high yield companies were very prudent in the last decade, and they simply extended maturity and they've improved their balance sheet. And so the quality of the high yield market is good, and I think defaults will stay low. That's why yield spreads have stayed pretty narrow.
Margie, isn't there a day of reckoning next year if this Federal Reserve isn't cutting interest rates? For those companies that pushed out that maturity wall, termed out their debt, don't they have to start reissuing in 2024?
I think most companies have a couple years before they have to worry about liquidity. So I don't think there's a real risk that companies aren't going to be able to refinance. And once again, is there access to money rather than the cost of money? I think at the margin, not that many corporations are going to need net new money because of maturities in the next year.
With that in mind, if higher interest rates aren't going to bite corporates in America anytime soon, doesn't that just extend the cycle, Margie, and keep rates high for even longer potentially?
Well, I think it keeps the economic cycle going. And really, I think the puzzlement has been, where's the recession? And there's no recession in sight because everything in the economy in the U.S. is really pretty well balanced. People aren't affected by this big increase in short rates. And really, right now, the 10-year is, 4.25? Maybe you'll drift up to 4.5. Those aren't exactly the sort of rates that choke off economic growth.
So if I've got a nice pool of cash right now, should I be worried about the reinvestment risk down the road, or should I just sit there in a 2-year in T-bills and relax and know that rates are going to be there next time I need to reinvest that money?
Well, I think it's likely that we'll see short rate, well, certainly much higher than they've been for the last decade of near zero. So yes, I think there'll be much more of a return for investors short-term oriented. But really, if you say the yield is, say, 5.25, something like that in risk-free assets, and the cash flow yield of corporations is maybe 5.5, 5.75, that says to me you're better off taking the volatility and looking at equities or high-yield bonds, which have a lot more to offer than short-term risk-free assets.
Margie, thank you. Margie Patel of Allspring Global Investment.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.